Good afternoon, and thank you for joining us for today's webinar, where we'll kind of discuss Q1 results, along with a little bit of just kind of a commentary on the state of things where they are, both from just an economic point of view, from what the Fed has said, and then what David's going to touch on a few points about credit. So thank you all again very much for joining us. As per usual, we are in presentation mode, which hopefully means you can hear me. But I can't hear you at the moment, so if you have a question, please submit those throughout the presentation, and we will take those either during the webinar or at the end. In addition, as always, we will send a link to the recording and a copy of the slides today, either later today, but more likely tomorrow or Thursday. So again, thank you all very much for joining us. My name is Sean O'Brien, the president of QwickRate, and I'm pleased as always to be joined by David Ruffin. David, for those of you who aren't aware, heads up our IntelliCredit division. We were fortunate to have him join our team in 2019 to build out what we call IntelliCredit, where we provide not only third-party loan reviews, but we've developed what we think are really interesting and insightful cloud-based applications for both internal loan review and as well portfolio analytics. So David's going to join us on the second half of the presentation today. Just a reminder, we are doing a number of different things here at QwickRate. QwickAnalytics, many of you have been introduced to our CECL solver over the last year and a half, where we also provided additional bank analytics and a research tool. And then again, David's division, IntelliCredit, where we, again, can perform and would love to quote you on your next third-party loan review, but we've also developed what we think are really interesting and exciting loan review and portfolio analyzer solutions. Today, we're going to talk about inflation. The Fed, as we kind of discussed last year, was looking for some inflation. Needless to say, they got that and then some. So we'll talk about that and where they kind of see things are now. We'll talk about the QCBI Q1 results. David will touch on Q1 results with a credit perspective. And again, we'll just kind of say share with what's going on here at QwickAnalytics on IntelliCredit and wrap up with any questions you might have. Again, I haven't put this to rest. At least we're getting closer. But, clearly we're still impacted by COVID in many ways. The mask mandate gone. You certainly feel closer to reopening, but there's certainly things that are still have altered the way we're doing and going about things. So it'll be interesting to see how that's impactful this year. But it's also, it's an international, situation as well, and so that's clearly impacting things in our economy as well. I think the big thing that I've kind of been mindful of this quarter, or the last 3 months or 4 months since the last presentation, this quote is attributed oftentimes to an economist, John Maynard Keynes. It's also been attributed to Churchill. I frankly don't have any idea who said it, but the quote is, when the facts change, I change my mind. And what do you do, right? And I think that's really kind of where the Fed is, right? They've been data dependent. That has left them exposed. We as individuals, don't prefer uncertainty. We love to live in a world of certainty, but increasingly, the more information you get, the more we live in a world of probabilities, and I think that's kind of where the Fed is right now, right? They're trying to manage probabilities. They wanted inflation, they got it, they got more than they anticipated. Now it's certainly run amok, and now they're playing the game of, is it going to subside here in the second half of the year, or is it really unhinged and going to go higher? And so that is really going to be, primarily the predicament they manage the second half of this year. As we discussed last quarter, right, they certainly seem to be moving more aggressively to try to maintain retain their credibility. So they raised to 50 bips. They'll probably likely raise 50 bips again because I think they are clearly more concerned about going too slow now and risk playing catch up, which, admittedly they are already doing. So again, the dilemma is not quite as difficult because they clearly are going to act more aggressively, but there's many who would argue they are still way, way behind and have a lot more to do. So that's what we'll monitor going forward. Certainly these interest rates going higher are affecting all of us at the bank. I think these first quarter numbers reflect the impact in some ways. For those of us who hold longer term or longer dated securities in our securities portfolio, we've certainly seen some unrealized depreciation in those. I've talked to some banks here in the last couple of days who are, kind of feeling the effects of a, 30 to 40% AOCI adjustment, in their securities portfolio. Then you have flip side, plenty of banks who have a lot of cash who are trying to figure out when do you deploy and for where on the curve and how long. And all at a time when rates are rising, which, typically portends, a recession out there in the horizon over the next 12 to 24 months. So, just all kinds of, really challenging things for us to consider at a time when, as we've talked the last couple of presentations, that loan growth is slowing. So, I think regardless of how long inflation stays with us, it's clearly impacting us at the bank level and our consumers. And so, there's going to be more work to do, but we're kind of approaching that time where it might be, worthwhile to buckle up because it's going to get bumpy here over certainly the next few quarters. Just a reminder, how much rates have moved. So this is off our Quick Bonds tab. For those of you who haven't noticed it, when you log into QwickRate, there is a tab for QwickAnalytics, but there's also a tab for Quick Bonds where you can buy and sell agencies, treasuries, mortgage backs, etc. But this rate curve, you can see, right, even in it's moved since yesterday when I updated this slide in the QwickRate marketplace, the 270 on a 2-year CD, 3% on a 3-year CD, and, agencies and treasuries are kind of, following in lockstep. So clearly, huge moves, and again, are, giving people with cash the opportunity to deploy it. It's a question of how long and where on the curve do you jump in. The Fed, their economic projections suggest a Fed funds rate of 275 by year end, right? That's still a pretty big move from where we are today. So again, the anticipation is certainly at the next Fed meeting, we're going to see another 50 basis point increase, and then, probably 25 the remainder of the meetings this year. So, a lot more to come, but this certainly has all kinds of implications, not only for our existing balance sheet, but just where growth and what the health of our consumers is going to be. In addition, the Fed has, along with raising rates, is reducing the size of the balance sheet, which is, again, going to slow an impact will be, to slow the economy. The raising the Fed funds rate, inflation is just, their expectation is that we're, tomorrow's a big day when they announce. I think many in the Fed are hoping that this will be the peak of where we are. Fortunately, unemployment remains low, right? We are at 50-year lows for unemployment, but that's probably going to tick up here as the second half of the year goes on, as more people may enter or re-enter the labor force. And then secondly, a lot of the government and fiscal support and monetary support, obviously with the expanding balance sheet and low interest rates, are obviously fading away. So, it's a small window. Some may suggest it's an eye, the needle in a haystack, but the Fed is still, hoping that they can, manage all of this without throwing the economy into the recession. It feels less and less likely. Most people put it about a 30% chance that they can do it, but it seems to be falling much lower. Part of us, again, we talked about, the only thing that's certain right now is uncertainty. I think this, slide just kind of suggests some of the conflicting signals that we see in the economy, right? We had 5.5% economic growth last year, and while it dropped in the first quarter, all expectations are that the economy will grow still faster than 2% this year, which again, 4 or 5 years ago would have been seen as a blessing. So the underlying momentum remains strong despite the inflation pains all of us are feeling. Household spending, Business investments continue to expand. The labor market is obviously very tight, but their employment gains were still seen in the first 3 months of the year, and we're at a near 5-decade low of 3% or 3.6% for unemployment. So again, a lot of good and bad. Labor demand is strong, wages are rising, inflation's rising, aggregate demand is still strong despite all of that, which is interesting, and I think part of the reason why the Fed thinks the economy can handle these higher interest rates and inflation, even though again it is very, very painful for most of us. The flip side, right? Obviously, the supply chain disruptions have been longer. Prices have been have spread across goods and services. Needless to say, the war in Ukraine is impacting the economy, as well as China effectively being on lockdown still. So just there's strong signs in the economy, but there's all kinds of clouds and overhangs to this thing as well. So the next few slides, I really put them in here more for you to maybe digest afterwards. I had gone through Chairman Powell's press conference, and just these are all quotes from him. I apologize, I forgot to put the quotes around each of them, but essentially I just grabbed some of the headlines from both his prepared statements and then some of the Q&A. But obviously they think they're moving faster to get to more normal levels. They think clearly that 50 basis points are going to be on the table the next couple of meetings. I was surprised. I think as many they have they have ruled out at this point 75 basis points. But their goal is to bring inflation back down to the 2% goal. Again, some other comments that he said: they're going to reduce the size of the balance sheet. Inflation has clearly surprised them to the upside. They're going to need to be continually more nimble than they have been with the data. And now they are, more clearly outspoken that they are attentive to the inflation risk. On the other hand, though, they do think the economy is very strong and well positioned to handle this tighter monetary policy. We'll see, but they're as they've discussed, right? Their instruments are better on the demand side, not on the supply side. So they're going to do what they can to try to maintain maximum employment and price stability. So again, it's important to keep in mind in context that even though things are bad, right, we are at record 5-decade lows for unemployment, right? So even if we back up here a little bit, we are at really strong points of in terms of employment in the economy. So for us, the implications at the community bank level, right? I think some of the signals again are a bit conflicting. I think the larger banks have been able to see some increase in continued loan demand. I think community banks, and particularly smaller community banks, are not seen as much as that. The interest rate, increases, typically occur over a 12-month period. So, as we get later in the year, we'll kind of reach that conclusion and see if we go beyond that or not. But I think the expectation for the Fed is that, hopefully, rates rising through the end of the year will do what is necessary to bring inflation back into line. We'll have to wait and see. So far, demand destruction has not been strongly evident, right? It obviously contracted last quarter, but the overall, the economy growing at greater than 2% is still, a growing economy. Those AOCI adjustments, I think, are something to continue to watch as these interest rates, increase. What kind of reaction is that going to get, or potentially cause or signal from our regulators is probably worth monitoring. And then, I think all of these things have the real strong possibility of, what the Fed's doing is to send us into a recession next year, or maybe even in 2024. And so for us, that obviously potentially brings credit implications, into play. So, I think, some other topics that we're watching, I think in terms of liquidity, while we've continued to see throughout the industry strong deposit growth, I will say here at QwickRate, since the fourth quarter of last year, we have started to see a firming in our marketplace, more banks are starting to come into the marketplace and look for funding. I think some of these other implications around the securities portfolio and CECL might bring people in. But I think it's worth noting that, when things aren't bad yet, are probably times we should begin, if we haven't already been doing it, start to potentially stress test, right? Whether it's our loan portfolio or our liquidity portfolio, there probably are some scenarios we should start to measure and monitor and just find out where we are. As you're thinking about your next loan review, maybe it's, coupling it with some sensitivities testing or even some loan level stress testing as well. But all these things, I think, probably start to come back onto the cards here as we move into the second half of the year. For most of us, we probably won't see any extra provisioning for CECL. For many of us, it may be that we want to draw back some reserves, which will, again, potentially catch the eye of our regulators. But, I think just looking at the first quarter numbers, it looks like most median numbers across some of the states I've looked at so far, the provisions are steady to rising. So we'll see how that plays out. And then I think another big question for all of us is what's going to happen with our loan and deposit pricing in our local markets, right? So far, I wouldn't say that there's been a lot of movement from consumers or our customers shopping for higher rates. I think most banks have been slow to raise their rates just because of the excess liquidity they have. That could potentially change here, later this year. And then I think the other thing as well is, right, how aggressive do you want to be in the loan portfolio? If you do have cash available, maybe this is when you can deploy in your securities portfolio. So, I think, again, a lot of decisions to consider, a lot of issues to evaluate. And again, I think makes for a as we said, a very uncertain time because there's just a lot of cross current and conflicting signals about how we manage things at the bank this year. So let's jump into the QCBI numbers. Again, we continue to see consolidation. We're on, just slightly above 4,800 banks now in the country. Again, you can see the breakdown. 50% of those are between $100 and $500 million, but 2 out of every 3 are $500 million and below. But now we're under 20% of the aggregate assets for the industry. As I mentioned, asset growth continues to remain strong. While it's still down over the last 12 months from where we were in 2022, 60% of the banks, saw 5 to greater than 10% increases in assets. And that's, again, been received and realized by banks of all sizes. Loan growth, the median number, and again, these are all median numbers, remain positive. So, still kind of, while slightly lower than 2021, where we are, ticking down a bit. But over to the right, you can see 44% of the banks in the country experienced no loan growth over the last 12 months. And in the bottom chart, you can see for banks under 100 million, but even the 100 to 250 million, it is a little bit slow going. And again, that's kind of, piling on for some of the banks who've already been, who are, facing more difficult times just because of the increase in technology expectations and just the rising, costs of labor. So again, it's, while there's been, very good things, there's still a number of challenging issues that we're all working through. Deposit growth, again, not as strong as 2021 or 2020, but still very strong. 44% of the banks in the country saw greater than 10% deposit growth. 73%, right? Almost 3 out of 4 saw at least 5 to 10% deposit growth. And again, realized by banks of all sizes. And so again, it does provide some potential opportunity if those deposits stay with us to potentially put that money to work, hopefully in loans, but even if not, at least in securities that can provide some meaningful return and yield. Yields on loan under 5% here over the last 12 months. Cost of funds continues to drop, which is nice. but now our median NIM for the industry, and for the community banks, is just hovering slightly above 3%, right? So we lost another 25 basis points over the last 12 months. And so again, that just speaks to the challenges we're facing. The rise in rates has really slowed the mortgage refinancings, and I think that shows up here in the next slide with the non-interest income to average assets, dropping from 52 basis points at the median to 43. And then again, with the slowing loan growth, that has caused or demonstrates or really gives a backdrop for the rise in the efficiency ratio, right? A lot of times, loan growth can hide a lot of operational costs or rising costs in our operations because the loan growth is so good. Now, as that starts to moderate and even slower contract, we may not be right-sized, and you start to see that not only in the efficiency ratio, but even earlier in that non-interest income expense to asset numbers. That's something that we watch in QwickAnalytics, and it's something that you should watch because, again, that's usually the precursor of a rise in the efficiency ratio if you see that number trending higher. Median pre-tax ROA, we slipped below 1%, and then you can see core operating earnings, dropped as well, just, slightly above 1% at the median. So, just speaks to the more difficult operating environment that all of us are facing. And then you can see in the median ROA numbers, we've dropped, 20 basis points to 78 at the median and 8% median ROE. And if you go to the far right, obviously the $0 to $100 million banks, feeling that the most, but we're just seeing, lowering numbers for banks of all sizes. And so, again, just not trying to beat the dead horse here, but, again, we went from an environment that was really, really good, and now very quickly it starts to feel a little bit, I don't want to say hangover, but we're starting to, there's certainly caution and some things that we're going to have to deal with over the next 12 months. Okay, so at this point, I am going to turn the presentation over to David. I'm going to make him the presenter, so give us a second, and we will get his screen up here. And David, I can see your screen.
Great. Thank you very much, Sean. Always a pleasure to be with the QwickRate family of clients quarterly. These numbers, as Sean has alluded to, are really, these credit metrics are really focused on the 10 billion and under, what we call the QCBI index at QwickAnalytics and QwickRate. One of the things that I think is common to these numbers that we'll show in a moment is that they've kind of leveled out from the big spike of 2020. I have to say this again, that most people would have thought that whatever spike we would have had in early 2020 would have been much more negative than it was. Of course, I think most of us realized that the combination of the regulatory respite and the government largesse that was deployed because of the COVID pandemic really took the numbers in a direction that not many of us predicted in March or April of 2020. So as you can see, the typical things we look at for quality, a highly generalized way of looking at credit quality at our banks and in the industry is total NPLs, which have just continued to decline in the last particularly couple of years. Net charge-offs are virtually non-existent on a comparative basis, certainly what they were 12 years ago. And the way that banks typically think of their ALLL reserves to loans, you've got and we've done this through regions, as you see, the 6 regions that are denoted in the color coding. A bit they're sandwiched by the banks in the West that have about 159, 160 basis points of their ALLL to loans. The other end of the spectrum would be banks in the Northeast, which are down to about 1.16. An inverse of that, and kind of my favorite way of looking at reserves, is to say how much of your acknowledged problems are covered by reserves. And at this point, these are mean numbers. Basically, are looking at again the West is showing well over 3.5 times acknowledged problems. Admittedly, the acknowledged problems or NPLs are very low at this particular point in time. And likewise, the Northeast, as we saw in the other graph, are a little bit lower. But again, they do have a little lower NPLs in that region. As far as concentrations, we tend to look at these each quarter. The ones that typically come to mind, of course, are real estate concentrations, because that's really the one loan product area that the feds have designated some guidance, not a regulation, but a guidance on capping exposure, at least identifying a threshold for certain exposure of concern. To the left, which is the subset of what we call the 100% guidance on construction development loans to risk-based capital, you've got the Southwest that's a little bit higher in exposure, and you've got the Midwest that's the lowest. As you can see at the bottom, you've got about 83 banks in the Southeast, 67 banks in the Southwest that exceed the 100% guidance. Again, just putting the banks probably on a little more notice that they may have to, or would likely have to, defend that concentration. On the broader 300% guidance, you have the West at 209%, and you got on the other end the Midwest at 128%. A lot of that, I think, is rooted on exactly this next chart, and that's the preponderance of multifamily in both the West and the Northeast, because they, in some cases, do represent significant urban markets. The C&I data is beginning to level off into a more normalized fashion after the big spike of the PPP programs. And then predictably in ag exposure, again, this is only commercial banking. It does not include the farm credit system. The Midwest pretty much leads the nation in terms of concentration to risk-based capital in that area. One of the things we've talked about in past quarterly updates, of course, has been loan growth. And even from a credit perspective, and I'm basically a credit guy, as they say, I've acknowledged and realized the issue going on with loan growth, because it does require for healthy bank franchisees to be looking at ongoing good, healthy loan growth. And that has been a big problem, I think, particularly for some of the community banks. The data that I'm seeing and commentary I'm seeing out of experts for the first quarter is some of the larger banks have really eclipsed some of the community banks in terms of loan growth. So again, for 10 billion and under banks, we're seeing, the chart above shows inclusive of PPP runoff. I've added a little subset here, a footnote at the bottom, as you can see, and this is a little bit of good news. If you net out the PPP activity or the runoff of that, actually community banks under 10 billion actually grew it over the last 12 months, 7.8%, which is not really as weak as we had feared a quarter or two ago. Everything we can discern is there's still about $13.5 billion of PPP loans on bank balance sheets under the 10 billion in asset categories. A chart I've also shared in the past is really perhaps the most daunting in terms of loan growth to commercial banks, and that is the fact that it is now estimated that the non-commercial banks are at par with commercial banking in terms of providing business purpose lending or C&I lending. And I think that is really a challenge that the industry has to realize, and it's certainly that dimension has increased significantly in the last few years due to fintech and the so-called shadow banking world. But other traditional competitors of commercial banking are also the credit unions and the like. But that remains an issue, I think, that everyone has to understand. I would argue, and I've said this again, I've been in this business a long time, and I would argue that credit quality metrics remain at generationally high levels in terms of quality. However, the credit the risk side of me has to say, yeah, but we have to, and alluding to a lot of the things that Sean has spoken to in this presentation in terms of cross currents, everything isn't just coming out roses. So I think vigilance, again, is still the optimal word here in terms of credit. I believe that what I would kind of humorously call the sugar high of COVID from government largesse is turning a bit sour. Inflation, again, arguably at the highest pace in 40 years. Rates are headed upwards and perhaps fast to help stem inflation, as Sean very well documented the current Fed's position on that. I think we have to realize this. There are two sides to every aspect. Banking is all about checks and balances. What goes up comes down on other aspects of banking, and inflation and higher rates, while they may help in the NIM world, they certainly do tend to empirically proven to weigh down on credit quality over time. I do think we're faced at some level with another insidious part of inflation. That's what I call the psychology of inflation. I'm hearing comments made by people can just throw in another 5%, another 10%, almost irrespective of what the real market environment of supply and demand is. And a lot of this is handled by, linked to the supply chain disruptions that a lot of people are feeling. But I think that's also adding a lot to, the pressures on inflation. And again, borrowing rates tend to outpace the ability to pass on a lot of that, at least in a more traditional way. So particular cost of borrowing in income properties, I know we have clients that are particularly looking at their book of business in income property to be sure they're keeping a gauge on the effect on NOIs and the ability to, ultimately repay the loan in terms of the debt component of that. I do think that what we're certainly seeing in both loan review, and we've been involved in a good bit of due diligence lately, is that we're seeing a move. Servicing is really becoming very challenging. And when I say servicing, I'm not talking about just the traditional mortgage servicing. I'm talking about post-booking servicing in commercial banking. And that is everything that's happening in terms of assessment of credit risk, obtaining financials, and so forth. Some banks, frankly, have gotten burned over hanging on too much to the 2020 mindset that, well, we just can't get updated financials from our customers. I know the regulators have become very aggressive in that area, in effect, not tolerating that as an excuse any longer. But there's another undercurrent of somewhat troubling and perhaps more permanent challenge to us in banking, and that is what I call credit staffing shortages. We're hearing this across the board. People have either lost talent or don't have the ability to recruit credit analysts in some cases, and I think we are going to unfortunately be dealing with for a couple of years now what this salary inflation that is going to really put traditional banking in terms of how we traditionally staff our credit functions, or for that matter, our lending functions, around expectations in the marketplace. So when inflation really starts taking on a salary implication aspect, that's going to be yet another issue. And we're seeing that morph into solutions trying to be created by, whether it's the correspondent banking networks or other groups that are popping up that are trying to, in effect, provide backshop support for community banks in the various and sundry credit administration and credit assessment ways. So I think that's another area that we'll be looking at and keeping a close eye on. Also, I think, chasing loan growth, as I spoke quite a bit to this last quarter about how the investment banking community is really making sure the commercial banks understand how important healthy, sustainable loan growth is for the franchise, not only the valuation of the franchise, but the profitability of the franchise. It does come at some risk when you're doing that in the face of all, as Sean would say, all the cross currents that we're looking at. As just spoke to, the competitive market is more competitive than ever. That tends to put pressure on pricing. It tends to put pressure on basic underwriting standards. And there is a lesson that we all live with, and that is loans made late in a credit cycle tend to be the most problematic when indeed the cycle does indeed turn. And I do think you just have to be asking yourself from time to time to get the growth that you feel like you need strategically. Are you consciously stretching beyond your comfort zone in terms of credit risk? Finally, I think this is a significant concern to me. I know the regulators, I've heard them speak. I speak at a lot of trade conferences. I've heard them share their primary fear is that of complacency, that some of those numbers that came out of the 2020 era that really just, in my opinion, rather artificially sanitized credit metrics, that somehow we as an industry are a little too complacent on credit risk. There's another flip side of that, and I think just as concerning to me is that an overreaction to any uptick of credit stress may be forthcoming. You know, there are some people I know in the banking space now that are predicting softening of credit quality, and you know, you hear the R word, recession, thrown about a little more than you did. And again, after a decade of benign credit, and even with the added capital and adequate reserves, I just worry that stakeholders on all levels, whether they be investors or peers or regulators, get spooked at the first uptick in credit stress. And because again, we've been in such a long, protracted pattern of what I'd call benign credit quality. Now, I think more than ever, however, is the burden is going to be on all of us in the banking world to make sure we write our own credit risk profile script before certainly a regulator does, or maybe even any external stakeholder does, because most people looking at banks tend to have their own perception of what the risk profile of that bank. It may be an added burden, and we certainly think at IntelliCredit we hopefully offer those tools that give you the ability to indeed do just that, write your own credit profile script, because I do think that's going to be a heavy focus of where we are in the next couple of quarters and into the maybe next couple of years. So that's it from the credit standpoint. Look forward to chatting with you in a quarter, and Sean, I'll hand it back to you.
Okay. Thank you, David. I think just to echo, I am getting a little bit of an echo. I apologize. What David was saying is, I think some of the tools that we use at QwickAnalytics and IntelliCredit are designed to assist with that. That we really spend time trying to position and utilizing that call report information. And I apologize, David, if someone's line's open, I'm getting an echo. I apologize. But we really want you to be able to see what your information looks from the outsider, right? So David talks about it being writing your own credit script. Again, I think one of the real advantages we have in QwickAnalytics is allowing you to see how you look compared on a relative basis to other banks, to other peer groups, particularly your UBPR, since that's what your regulators are looking for. Because again, you not only want to, your own story, but making sure that's communicated and understood by your regulators is important. And oftentimes being simply aware of how you potentially might look on a relative basis can be helpful. But more in particular, if you are looking to defend or support a position you're taking, often within your loan portfolio or your loan mix or concentrations, et cetera, that's where, again, some of the tools that David and his team have built at IntelliCredit can support. So, again, I think we're just, these are some of the practical ways that QwickAnalytics and IntelliCredit can help. Obviously, those peer numbers allow you to see that. The interactive bank pages allow you to see that. And then, certainly I think a lot of you have become a lot more familiar with QwickAnalytics through our CECL solver, but we do also have a portfolio level credit stress test that can be, again, informative and helpful as we move forward here over the next year or two. In terms of David's team, again, we've developed what we think are very exciting cloud-based applications called Portfolio Analyzer and the Smart Loan Review. And then David and his team still do and perform traditional third-party external loan review engagement. So a number of ways that we can help. We'd love to be able to quote your next loan review. So if you're considering one of those in the near future, we'd certainly welcome the opportunity to show you what we can do and make that process not only hopefully not even more informative, but even more efficient. Again, just that's what we're really trying to do here. Repeatedly, we're going to constantly tinker with our solutions, look to add value where we can, and most importantly, do it in a way that is affordable and able to be deployed by our community bank customers. Right? All the best technology in the world doesn't help you if you can't adequately or effectively deploy it in your bank. So often the limiting factors for a number of banks is cost and or just the ability to use it. We try to always top of mind make that a big part of how we design our tools. Just a reminder, while we thank you all very much for showing up here today for the webinar, we have had coffee talks, the next one being this Friday, that have been tremendously received well by our bank group, where we just take questions from you, not only our users, but even prospects about CECL. We'll touch on a few topics that we're hearing from our over 250 banks who are using our CECL solver as their preferred solution for CECL. And so we'll take those, and our next one will be this Friday at 10 Eastern. If you want to see a more in-depth demo of our CECL solver tool, we have a webinar for that on May 24th at 2 p.m. Eastern. In between, you can certainly email us or call us to schedule a time to walk through the tool, answer any questions you might have. You can reach us at info@QwickRate.com, or you can certainly just give us a call as well. But certainly appreciate, again, the opportunity and the willingness for you to take time out of your busy day to join us. I hope you found the presentation helpful. I'm just going to check one more time to see if there are any questions. I don't see that there are. So on behalf of David and myself, we thank you for joining us. We'll look forward to speaking to you again in a few next quarter. And in the interim, if we can help with anything, don't hesitate to reach out to us. So thanks a lot. Have a great day and be safe and well. Bye now.